Okay, very good morning. Hope everyone is well. It is Thursday the 15th of February. If you're listening from China, then Gong Hai Fat Choi. It is New Year. Enjoy your week off. We'll be celebrating here in the office. I'm going to do the briefing in full traditional Chinese costume tomorrow. Having a look what we're going to cover in the briefing today, we have I guess a little bit of a recap of the aftermath of yesterday's moves and the US CPI data, a really big focal point for the week. Where are we with things at the moment? How does the land lie post that big event? Then I'm going to talk about a few other news items, a quick look at Brexit, of course, always something to comment on that issue. And then I'll hand you over to Sam, and then he can talk through some of the trades from yesterday that some of the guys did, but also have a look at the day ahead and some of the setups. So first things first, again, I'm not going to comment myself too much on the charts, I'll leave that to Sam, but the overall look of the assets as they're trading is still a continuation of very much what we had yesterday, which is, apart from the momentary move that we had in initial knee-jerk reaction, the bigger overwhelming trade was that of equity markets quite sharply higher. I mean, the close on Wall Street, we were up 1.3% in the S&P, just shy of 2% in NASDAQ, the percent gain in the Dow. So, I mean, just checking out the center right chart here, after the initial knee-jerk response to those slightly high inflation numbers, the market had already recovered the entire move within about an hour and a half, and then we actually finished and closed out the session, almost doubling up the actual size of the move, which we nearly fell. So, really positive response for equities. Gold rallied. We're still flat this morning, but holding on to the big bulk of the gain. And the dollar weakness obviously elevating both major pairs, which are up fairly nicely again this morning amid some further extension of the dollar weakness as European participants have come back into the market this morning. So we're trading back above a 125 handle in euro dollar. And we're up at 140.50 or so. Again, it's not so much a euro or sterling specific story. This is just the continuing trend that's been in play really for about a month now of just dollar weakness prevailing. Consequently as well, on the back of that, oil, it's helping support oil prices. We're back to 61.16 this morning in oil, and obviously that was helped, the move higher, fueled by the weekly inventory data. The crude, the Cushing, gasoline all being bullish, irrespective of the fact that US output went up again, about 0.2% to now track at 10.27 million. The market brushed that aside and actually focused on those other more bullish elements of the inventory report. That, with the weaker dollar, saw crude also power higher, and that's also lending its hand to some of the equity support. And here we are, just printing session highs in the SPOOs at the moment. So a quick look then, and one of the main things that I thought was interesting was and what was really great to see actually from some of the traders here on the floor was the actioning of patience on a major piece of economic data. Now yesterday we knew it was going to be a volatile release because of this kind of massive focus on inflation at the moment as a byproduct of the huge volatility that we saw at the beginning of the previous week. That being initiated by these renewed inflationary fears and what that as a net result might mean for policy going forward. So this inflation data yesterday was like really critical for that decision making and where are we in terms of present day inflationary environment. And one of the things was, it was almost if the market was so hyped up that we were expecting strong numbers, and we did get that delivered partially, where we had slight beats on both the year-on-year and the core, but neither of which broke the upper bound of the analysts' most optimistic ranges of how high inflation could have gone. Retail sales as well was weak, and the real earnings numbers in the retail sales report was down. And so actually what ended up happening was the market kind of, on further digestion of the numbers, saw a really nice recovery and then a quite counterintuitive to the first move. And I know that some of the guys there traded that really well on the floor, which is really pleasing to see. This whole kind of idea that to trade economic data effectively, it's not just about trying to react instantaneously as the numbers come out. It's about really understanding What is it? How is the market positioned? What is it that the report as a total, a summary, the CPI and the retail sales collectively, what is it telling you? And then, you know, picking your time to technically well execute a trade thereafter. So Sam's got some examples I'm sure he'll go over, but a job well done for those who were involved in, I know, some of those currency and equity moves yesterday. What does this mean going forward? Well, a lot of people, obviously, the debate rages on between, are the Fed going to stick to their current line of communication of 3 interest rate hikes? I know for one, the chap sitting just to my right thinks no, they're going to go for 4, and he's not alone. The likes of Deutsche, Goldman Sachs, they're all looking for 4 interest rate hikes, not 3 from the Fed in 2018. Just saw quite an interesting article in Bloomberg this morning. It's saying this: while the Fed soon signal 4, or will the Fed soon signal 4 rate hikes, don't bet on it. That's what Bloomberg is saying. Now, the reason why they're saying that don't bet on it is because lifting the dot plot's median would require quite a dramatic shift. Now, playing devil's advocate, I can call it both ways, if you like. Now, this is the current dot plot as it exists in its current form. Now, in the December projections for the dot plot, only 4 officials said 4 or more hikes would be appropriate for 2018. So at the moment, that's not the median consensus, that's the minority. To lift the median dot plot, which is obviously key for the end of the year 2018, 4 additional colleagues would need to join the existing 4 then to tip the balance. Now, obviously 4 is quite a lot, so there'd need to be a meaningful shift of quite a few members in order for it to flip from 3 to 4 rate hikes. The one thing I would say, though, of course, is this: the composition of the FOMC, as you well know, has quite subtly shifted to being more hawkish. So does this then supplement the view that, well, yes, granted, there needs to be quite a few more members voting for 4 hikes, but the way of which now for 2018, if I had 2017 written here, on an average, I'd say we were probably sitting up here, kind of neutral to basically right center, whereas at the moment, if you took the average kind of policy view of the voting members of 2018, I'd say it is distinctly lower towards the more hawkish end of the spectrum. So we are expecting a more hawkish vote pattern going forward, and obviously this is all gearing up for March, and March being key because we get the latest projections. That's when we're expecting the Fed to pull the trigger for the first hike of 2018. But then interesting will be, if they're going to switch to 4 hikes, we need to hear that in March, because they've got to lay the ground then for the subsequent hikes thereafter. Most likely, if they're going to do 4, March, June, Sep, Dec, of course, being the projections and press conference months. Okay, so that's the situation in the aftermath of inflation yesterday and Federal Reserve thinking. Other things just to make you aware of: any of the guys who are trading overnight, Aussie data did come out, but probably one of the first times in a long time, the Australian employment change and unemployment rate was pretty much in line. Not very often I've seen that data come in line. It tends to see huge statistical variance month to month. It makes it very hard to forecast, but the fact it came in line, the move overnight's been fairly tepid, I'd say, in Aussie dollar. However, the Aussie has broken an interesting resistance level this morning in the futures at around 79.46. We've managed, I'd imagine that would be a pretty good support point now for the longs. But again, Sam will go over that in a second. The other thing I just quickly wanted to mention, I did send this research out to you guys going forward, and this is a quite a nice, straightforward, concise piece of research, as usual, by the chaps at ING Research, and they're looking at bad Brexit vibes return, but this time may be different. A couple things here I just want to look at, and obviously we know the timeline. March 22nd, 23rd is the key EU leaders summit. Now, this summit is particularly pivotal for Brexit negotiations, because this is where transitional deals need to be done. Now, the interesting thing was, you had Boris Johnson talk yesterday. He kicks off what is a sequence of Brexit-related speeches from the kind of senior cabinet. Now, Theresa May, the Prime Minister, is set to outline her vision on UK's future relationship with the EU in a series of speeches over the next few weeks. The first of which, of course, comes this Saturday, the 17th. We'll also hear from Bojo, or we have done. We're going to hear from David Davis, the Trade Secretary Liam Fox, and others. So some really important Brexit speeches to come. Now, what's interesting here was they've done some research, and this was looking at the asymmetric sterling reaction to May's previous speeches. So the impact that when Theresa May speaks, that what she says, and it's one-day change then on the pound. And what you can see here, we go all the way back. Do you remember the Lancaster House Brexit speech? That was when Theresa May outlined her 12 principles of Brexit, when there really was no information about Brexit at the time, and the market loved it, and the pound rallied aggressively. When Theresa May became PM, not sure if you remember that, but at that time particularly there was a lot of political uncertainty when David Cameron resigned, given the result of the EU referendum. People thought there was going to be several months of toing and froing going through this Conservative kind of internal party mandate of how they select a new leadership, but actually Theresa May came to the forefront very quickly, which was a sterling positive. And then you had May call the snap election, and of course that's when everyone thought, well, it's a slam dunk, Tories are going to get a massive majority in Parliament. And we had one of the biggest intraday rallies in recent memory for the pound. What's interesting, of course, is you could pretty much draw a dotted line straight down the middle here between pre-election speeches and post-election speeches. And obviously the biggest down day that we had was when Theresa May's Tory conference speech. This is when she had the coughing fit, the P45 came from the crowd, the letter fell off the stage. That was absolute shambles at the time, and you can see that reflected quite clearly in the market price. What's going to be interesting here, and actually I think that this trend certainly which has been forming when she's been talking is probably going to continue, and that is because if you think about what's coming up, and the reason why her speeches more recently have been met so negatively is because she's having to toe the hard Brexit line in order to appease her supporters, who of course tend to be more of the Brexit view, and hard Brexit tends to be the message that sits best with the voting electorate, backing her principles of Brexit. And so going forward, if you think about the situation, you've got local elections taking place in May. Her leadership is already looking fragile at the moment, and so you can expect her and her senior cabinet officials in these upcoming speeches, I think, to sound increasingly pro-Brexit in a sense of getting the best deal for Britain, i.e. playing hardball with Europe. The problem that this obviously initiates is that the more you pander to that view politically, domestically, the more you're going to draw a bigger divide ahead of key European level discussions in March. And this is why I think the March EU summit is going to be an absolute disaster. I just don't think this transitional deal is going to be as plain sailing as a lot of people think. And so, yeah, going to be certainly interesting. These speeches to watch going forward. The point being is that I would be anticipating volatility around these speeches, and the bias would be negative reactions given the hard Brexit stance that's likely to be issued. The only saving grace, I guess, for the pound still at the moment is the dollar, and that's because the dollar continues to remain under quite severe pressure, and that's exactly the case again this morning, down about 0.3. This morning's cable move is more to do with the dollar and technical breach of the resistance level from late yesterday in the US session and the Asia Pac session. All right, quick look at the calendar and let me hand you over to Sam. So for the morning, things are relatively quiet. There's not a great deal going on, but in the afternoon, a few things to be aware of. Your regular weekly jobless claims, you got your Philly Fed, you've got your PPI numbers, industrial production, NAHB housing market index. I would say these are all worth monitoring, but are they going to really shift sentiment or direction in markets across asset? I'd say it's unlikely. Speakers, though, there are quite a few things to look out for as we go through the morning. all of an ECB perspective. And then if anyone's trading fixed income futures, then just be aware you do have the Spanish Tesoro and the French Tresor coming to market with a combined upper end of close to 13-14 billion euros worth of bonds today. So whether or not we see a little bit of price pressure playing out ahead of this large amount of supply that's going to hit the market later, yet to be seen. All right, hand you over to Sam and wish you guys a good day, and I'll catch you in the chat room.
Yeah, good morning, guys. Hope everyone's doing well. As Ant mentioned, we'll go over some of the trades from yesterday, which were taken from some of the guys in house. I know some of the guys at home as well did very well off what was perhaps where it was in the end. A bit of an overreaction from the data release, which overall was actually kind of mixed anyway. But obviously saw the dollar strengthen off these numbers, and you can see here. Let me just circle it, make it a bit clearer. The move to the downside. All dollar pairs, except maybe dollar yen, coming under significant pressure here. With that sort of reversal, and if we just take this down, I'll put it on a 5-minute chart just to go into a bit more detail. I mean, especially for the euro, there's a couple of opportunities before we even extended quite a bit further. We had quite a good rejection down at the original low, and I mean, you'd have to be brave to have taken it on around there, but a couple of opportunities came in once we broke through the S1 in this case. It came back, you know, if you didn't get the first bite of the cherry on the breakthrough around here for the long on the sort of the classic of that. We then broke through the previous high we made on the initial pullback, and that really you know, a couple of people got in on that, and it was a lovely trade. But each time we sort of came to what would have normally been an area of resistance, we carried on breaking through. You can see we're pulling back to previous resistance points now to act as support, and then even the R1, the classic of R1, later in the day, just after 5 o'clock for euro, offered good opportunity on this weakening dollar, and it's exactly the same really in the pound, and I'll come on to the Aussie dollar as well. But some good opportunities when we did, you know, break through what were previous sort of pullback highs, and is all sort of at the same time. And here was a lovely trade. You can see what was just before the data released, the sort of the high above that pivot. Once we did break through there, similar time euro was doing its thing on the similar sort of resistance point, pulled back, acted as support, and then again that classic of the R1 working pretty well before sort of rallying into the rest of the evening. Aussie dollar, which actually, and we were speaking with the guys in the house at the time, it sort of really was the one that reacted the most to the initial data release, making the biggest move to the downside. I mean, obviously other than gold and T-notes at the time, but this was a good opportunity once we did break through S1 to the upside, and then similar sort of fashion in breaking through previous resistance levels, carrying on, finding a bit, albeit very short-lived resistance at each point before then breaking through. And you know, even late on in the evening, I remember speaking to the guys in Bahrain at the time, you know, once this level breaks, you're going to get the further push through, and that did happen to the upside. Gold perhaps gave the wink early on, you can see here, and if I just make this chart a bit longer dated, you can see came to what was the low, what's that, so Wednesday, Tuesday, Monday low, week low, before bouncing, and you can see just the reaction that we had there, lowering that time frame down, just to show you that well, look how big this rejection here is, and you can see within 5-10, well, half hour, the whole move had then been taken away. At the same time, you had equity markets pushing to their highs. Let's just roll through that. Here you can see took a bit longer, more, you know, 2 hours from the release to completely redo that, and then we had a battle around with the R1 for quite some time before pushing on. And then you can see this morning, as I just take this chart to the right hand side, we're now still pretty elevated, the highest we've been since, really, let's just put this on a longer chart, almost the highest since that important point in the market we've been talking about on the 7th around here. this is a big level for S&P. You've got R1 in the mix there. You've got the high of the 7th, and then really where this sell-off started to gain its real momentum. If we can break through, and I think it's more important if we close above there at any point, and then you can start thinking about really, attacking the all-time highs again from there. I think this is a big level. The Dow Jones and Nasdaq had briefly broken through, but not closed. So it'd be interesting to see how all those markets sort of treat their similar levels here. So you can see this is where it would be for the Nasdaq. And there you go, failed close. So it pushed above but came back down. So now let's see if we can consistently push above here. If we have a quick look over possible opportunities today, here we've got in the euro, I think you've got to go with the dollar weakness. For now, you've got a bit of data obviously out in the afternoon. Yesterday's / overnight high could offer a good area of support. I don't think we're going to get down to the pivot unless there's any news related, but that should offer a good area of support as well. Just taking a look back in terms of levels to the upside to be aware of. You can see, let me just mark up the high that we had back in January, and then this one here is going to be quite important. The 1st of Feb, the high of the month. I don't see any reason why we can't necessarily get a test of that later. Important resistance area around there. I don't necessarily think we're going to smash straight through. You've got highs all over the place around here, so perhaps some short-term resistance, looking for the pullback to then go long. Similar sort of approach to pound, I would say. You can see the 141 handle, R1, and the low from the 2nd, high from the 8th. This area is going to be pretty important going forward, and anyone that perhaps still has long positions on will definitely be looking to take some profit away from that. Shorter time frame, more intraday perspective. Again, the previous high of the day, similar to euro, could offer some support here. However, it has already worked, so I'd just be a bit cautious about that. You can see there we broke through and came back down for the classic around 7 AM. More safe option would be looking for any of these sort of previous support areas around 140 on the futures, perhaps. Equity markets, I think you just got to be thinking, where's a good place to get long at the moment. That sentiment is definitely to the upside, but we have the R1 and those important areas definitely in S&P to take into account. And if you do see some strong selling around there and then we push back lower, obviously you've got to adjust and be reactive to that. The DAX, which gapped higher initially on the open, didn't take long to fill that gap. We're now pretty mid-range, so I keep more interest on US equities in the DAX. Unless we do perhaps break either way, and I'm just going to put this on a shorter time frame, perhaps got a bit of a trend line to get on here, just this is roughly drawn, but to see if that's been respected, then you could perhaps get that breakthrough. Previous low of the day, and then the high here, a breakthrough this sort of area, testing of the highs, especially if US equities continue to push higher. Oil as well, let's have a quick look at that from yesterday. It was a 15-minute chart here. Initially you had the push through, we broke through the pivot, the high of the day, hit yesterday's high, especially on the data, that's a pretty good test of that. Came back down, the pivot again offered quite a good area of support along with $59 handle, didn't quite get down to the 11 AM high, but then again once later in the day we had the push from what was the new high, came back for the classic. So there was some good opportunities yesterday, and ones that didn't necessarily have to be all too aggressive. They all mostly came back to test the level. So I would just avoid anyone perhaps thinking today is going to be a day where you have to be super aggressive. Be patient, waiting for the level you want to come. Trade your best idea is basically what I'd be looking at there. Oil, obviously, if I make this chart a bit longer, you can see rallying over the last sort of 24 hours following quite a few down days in a row. Areas to the upside to be aware of. I think you've got to take, both the low of the morning of the 7th, $62.85 and $62, and the $60.09 here, the high of the 8th, should offer some good resistance for anyone that would want to continue this trend. Would also be worth getting a trend line on, going from the top which is probably broken, so that could offer an area of support if we were to come back. But yet these markets, which over the last couple of weeks have been, sort of showing a bit of dollar strength, equity weakness, oil weakness, gold weakness, well, you're starting to see perhaps that turnaround here. Where we close today, and more importantly the week, will be important. One thing just to be aware of is that T-notes again have made a new low today, breaking through last week's low quite convincingly. We just hit the S1 of the day, so I would just be aware of that. If we do see continued sell-off in an aggressive manner, just something to be aware of as we approach that 3% yield. Any questions, please get them in the chat. Obviously we'll be posting charts throughout the day, but I hope you have a good Thursday, and I will catch you later.